To begin, we first looked at Walmart's balance sheet from 2018 to 2020. As we can see, both sales increased and the cost of goods sold also increased. We can also see that Walmart's gross profit from 2018 to 2020 has also seen an improvement. From 2019 to 2020, they saw a 0.198% increase. In order to make our proposal, we had to find Walmart's projections for 2021 and 2022. We did this by calculating the projected growth rate from 2018 to 2020. We found that the 2021 prediction and 2022 prediction showed that there was going to be an increase in their sales. This is further supported by the graph in figure 1, which shows that from 2018 to 2020, we saw an increase in their sales. Therefore, it would follow this trend line.
Using the average growth rate calculated, it's predicted for the free cash flow to increase in both years 2021 and 2022 as shown in the table, which suggests that Walmart is forecasted to be in a better position to pay their dividends and grow their firm through investing. However, in 2019, there was a decline in the free cash flow value by 9.14%. This may be due to a lower net income in 2019 caused by a higher cost of goods shown on the balance sheet, or it may be due to Walmart's decision to increase their capital expenditure to fund the e-commerce site as stated in a 2019 article. This is further highlighted by an expert O'Shea, lead Walmart analyst at Moody's, who suggested that spending more on the e-commerce site is a powerful model to compete with Amazon, who is Walmart's biggest competitor.
Walmart is clearly being threatened by Amazon, who is currently dominating in many departments. From figure 2, we can see that the share of consumer retail spending for Amazon has been rapidly increasing, catching up to Walmart. This is a threat to Walmart. Perhaps changing their capital structure would be a good option to increase Walmart's value in order to compete. As seen on the balance sheet, there has been a 10.9% increase in total liabilities from 2019 to 2020. In the same years, the value of shareholders' equity increased by 2.41%. This shows that Walmart favors debt financing over equity financing, as they have larger values and percentages. Debt financing holds less risk. Although debt requires repaying loans with interest, it has lower cost than equity financing. This is because reissuing equity requires selling a part of its ownership to its shareholders, which involves consultation from investors. This could explain why total liabilities is larger than the value of shareholders' equity. It gives Walmart the ability to produce consistent profits so they can sustain a good stock valuation, pay their dividends, and compete with Amazon. Furthermore, debt financing is a viable method as Walmart is projected to see an increase in their free cash flow, which they can use to repay their debt.
Evaluating Walmart's current financial policy. There are many factors to consider. The projections that were calculated may not be very reliable, as in a climate like today with COVID-19, economic conditions are very uncertain. In addition, these figures do not take into account that Amazon is rapidly beginning to overtake Walmart. If Walmart continues to remain at their current capital structure, they will fail to hold the dominant position in the market. Hence, raising debt financing is the optimal decision for Walmart.
We looked at the debt-to-equity ratio. This helped us think about what we can do for the proposal. The main trends are shown by the graph. The long-term debt has been relatively high in the last 2 years, shown by the first graph, averaging around the top 40s and the 50s, compared to 2006, where it had 20 billion. Now it has 40.49 billion. You can see that it has doubled overall. The debt-to-equity ratio has had a sudden increase, shown by the steep slope, in 2018 from 0.41 to 0.7. It has fluctuated amongst high figures till early part of 2020. It finally has reached 0.45. Is this too low for Walmart in this particular industry, and can it actually use more debt and take advantage of it to expand and grow? This is proven by the WACC calculations and the examination of the credit ratings. Examining the credit rating. We found that Walmart is a blue-chip company and its debt is rated investment grade. So there is a high probability that the firm will meet its debt servicing commitments in a timely fashion. On the table, you can see that the agents Standard & Poor, S&P and Fitch have rated it as a AA, and Moody's has rated it as AA2. So you can see that it has been given just below the highest rating by the following agencies. So we know that Walmart will be good at meeting its debt commitments.
WACC is commonly used as a hurdle rate against which companies and investors can gauge the desirability of a given project or acquisition. To work out Walmart's WACC and firm value, we use the following assumptions. To obtain a value of 3.58% to 2 decimal places. With this low value, it indicates a healthy business that's able to attract investors at a lower cost. It means that Walmart is seen as less riskier and does not need to compensate investors with higher returns, further again pushing the agenda for a proposal of increasing debt to increase value. Using the assumptions discussed in the previous slide, we obtain the pre-tax WACC and WACC to then find out the firm value. You can see that the firm value with the WACC becomes 562.85 billion, considerably higher than the pre-tax WACC, which comes to the total value being 178.86 billion. This proves the advantageous effects of debt, whereby the interest tax shield is exploited.
Some of the risks involved with debt financing in our proposal are the cost of debt, which is the interest payment on the debt, such as bonds, over-leveraging, which is when Walmart's debt will be taken against future predicted business earnings. If Walmart takes on too much debt, they won't be able to keep up with current business expenses. Future limitations, which is when Walmart's debt levels are too high and banks and other creditors will hesitate to offer Walmart more finance. A slump in sales, which although most of Walmart's goods have inelastic demand, depending on economic conditions, this could occur. Business expansion, which would drop if Walmart focused most of their financial power on debt servicing and balancing debt ratios, and bankruptcy, which is when Walmart would lose business ownership to creditors after late fees and default. Some of the assumptions we made when making our proposal was that Walmart's debt-to-equity ratio is 0.45, since Walmart's long-term debt is $40.5 billion and shareholder equity is $90.8 billion. If the debt-to-equity ratio was any different, or if debt was significantly larger than equity, our shareholder proposal would focus capital restructuring around reducing servicing debt and issuing equity, mainly due to the increasing probability of default and increasing financial distress costs. Our second assumption was that Walmart's leverage is not optimum to maximize value and exploit interest tax shields. If this was not true, a change in capital structure would not be required. In the worst case scenario, if Walmart got into financial distress because of our proposal, the indirect costs would be managers in Walmart cutting down investment opportunities, managers not having enough attention to growth and maintenance of the company, Walmart losing customers due to the blow to their reputation, Walmart having less favorable trade credit terms with suppliers, more aggressive industry competitors such as Amazon and Target using weakness as an opportunity to steal market share, higher costs of capital, and increasing interest rates. Some of the direct costs could be Walmart facing bankruptcy, which would incur further bankruptcy costs such as legal, management, and auditor fees, valuable human capital departing, and asset sales occurring at distressed price. Creditors would also be impacted. They would have to wait years to receive payment and would have to hire their own legal representation. If in financial distress, conflicts of interests would occur. When confronted with the idea of a risky investment opportunity, creditors to Walmart would not recommend engaging, instead preferring to preserve their assets and being able to collect what's owed to them, while owners would want investment to go forward for profit gains.
Looking at the past proposals for 2021, we can see that some are linked to the regular operations and structure of Walmart, like the election of directors and ratification of company accountants. The creation of a pandemic workforce advisory council was proposed to help mitigate systematic risks, but we think these efforts are duplicative considering the guidelines already in place, and the majority of shareholders agreed. Other proposals focused on corporate social responsibility, like a report on alignment of racial justice goals and starting wages. This failed to pass, but we think Walmart should consider this as a social objective, considering the high percentage of its hourly staff being people of colour who would benefit disproportionately from this wage increase. Some other proposals look to increase transparency for the company. However, they do not look to explicitly add value to Walmart as increasing debt financing proposes to do.